Hi, everyone. Welcome to another DPI Presents. I am so excited today to welcome Miss Lillie Anthony of A&A Financial Tax Services. We just had our Reimagine event, and I will put the information in our description below, so you'll have the link to that event. And she was giving such incredible information about what we can do now to prepare ourselves financially for tax time, which comes very quickly at the beginning of 2022. So I just wanted to bring her back on so she can continue that dialogue. So welcome, Miss Lillie. It's so great to have you with us today. Yes.
I enjoy talking about taxes.
Yes.
One of my passions.
And you bring such a positive energy when it comes to talking about something that most people, as I had told you kind of beforehand, will think is actually boring. But what you were providing us was just great, solid information. So tell us a little bit about yourself and how you your background, how you came into this tax love and passion that you have.
Well, my tax story actually started right after college. I was ROTC graduate, went into the military as a first lieutenant. Mm-hmm. And when I filed my very first tax return, which was like about a year and a half later, when I went in the military, the tax preparer that I was working with, I was all excited about this huge refund. I just got married, we bought a house, we was getting this huge refund. And the preparer was like, no, this is not good. I said, I'm getting a refund. This is good. That's what I'm saying to myself. But he said, no, this is not good. He said, all you did was gave the government opportunity to hold your money all year and give you an exact refund back. I was like, oh, so that's how I got into taxes and being more conscious about my taxable income versus my tax liability. Because in the military, a lot of our income was non-taxable because they were housing allowances. So I didn't have to have all of those withholdings. So that's how I learned how to, learn how to manage my tax liability throughout the years. So I took the H&R Block tax course, and I learned how to do taxes when it was manual. It wasn't computerized. We had to memorize every IRS tax form and prepare taxes with our hand. And then a reviewer will look over the return and says, okay, you did your calculations correctly. So I learned very, very early back in the mid 70s, beginning 80s, how to do taxes manually. Wow. So that was my tax story that got me involved with taxes.
Wow. But then what is so unique about you is the time that you have spent with the IRS. And I really think that that is what differentiates you from any other accountant or CPA, is the fact that you were an enrolled agent with the IRS. Tell us a little bit about that.
When I started with IRS back in 81, no, actually at 79, 81, 79, 80, I started with IRS. And actually it was a little bit later, but when I started with the Internal Revenue Service, I originally started with being a revenue agent, an auditor, going out in the field, working with small business owners and auditing their books. But the one thing I seen over and over again with small business owners was that the mistakes they were making in their books and their accounting was just very small things that if they had known the basics, did separate personal bank account from the business bank account, just little small things that the accountant didn't just give them additional advice on. And I kept saying, when I retire, one of these days, I'm just going to start my own business. I'm just going to start teaching. My girlfriend and I, we decided we were going to teach workshops and just help train small business owners, because a lot of times when they get behind in taxes, had they just got it right at the beginning, it would have avoided a lot of the hassles and the tax liability, extra tax liabilities they had later on.
Wow, that's so good. Because I remember when I first started talking with you, this is obviously very, having your tax accountant, you really think about this is a very intimate space when you talk about your finances. And one thing I remember you saying to me, if more people just set up their business the right way, the foundation of it, and the fact that you have this heart to educate and make sure that small business owners have that solid foundation, how they set up their tax structure. So that is why DPI is so excited that you are here with us. I know you've been with us twice with the Reimagine event, but to have you one-on-one. So I just wanted you to kind of walk through the presentation that you did at Reimagine. I know you got cut off. There's just so much to know, and we won't cover everything. I will say that this is just disclaim purposes. This is for educational purposes only.
Perfect.
We provide suggestions, but for those that are viewing, you, the business owner, makes your final decision. So I just want to make sure we have that disclaimer. So I'm going to share my screen here, and I just wanted to kind of have you walk through what should someone be doing now in regards to getting themselves prepared for end of year tax time.
Right now is our mid-year tax planning season. We've gone through the first 2 quarters of the tax season, and small business owners right now should be reviewing their profit and loss statements and their balance sheets so they can see where they're going to, end at the toward the end of the year. Because if you wait till December 31st to start reviewing your profit and loss statement, your balance sheet, it's damage control. It's not much you can do at the end of the year because you've already missed that window to add in additional equipment, to replace vehicles if you need to replace vehicles, or purchase new computers or laptops, or other equipment that you may need for the business. So if you review those statements mid-year, it gives you that opportunity to then later on to adjust for that taxable income at the end of the year and to reduce your tax liability, to include when even managing your credits. Credits too can help reduce your tax liability at the end of the year, because you may need to put a new roof on the office building that you're working out of, and that would give you a credit at the end of the year, depending on what type of solar energy or some type of solar credits that you may be using. And also reducing your tax liability helps build your asset wealth. So if you're gonna plan throughout the year, reduce your taxable income, save on your tax liability. Now, what are you going to do with the funds? So then working with a financial advisor at the end of the year to decide where you're going to shelter some of your funds after you finish preserving your money that you've worked hard for all year.
That is so good, preserving that money. So I love how you talked about the forever tax plan.
Yes, the government only has one plan, and it's taxes forever. You have to decide on which category you're going to stay in forever, and how you're going to shift some of those funds from being in this forever tax plan, because we have federal and state taxes, which includes income taxes, self-employment taxes, payroll, probate, estate taxes. And on the state side, we have the unemployment taxes, the FUTA. We can always have sales and county taxes. Business income taxes, they can be managed. If you plan it correctly, the business income taxes can be managed.
Yes. And that is why someone is, if there are things that you are saying and they're like, I am so confused, it is going to be so important that you reach out to a professional like Miss Lillie Anthony, because it is, really preserving that money. I love how you said that, and being able to know what you're going to do with that preserved money and building that wealth, building those assets. So that's just great information. And then when we were talking, you talked about deduct everything. And I think this is where business owners might get tripped up. It seems like the laws are always changing. Again, another reason why to be with a professional. So tell us about some of the things that small business owners are able to deduct.
Before we talk about deductions, it's all about organizing too. You've got to keep yourself organized, because your accountant is only able to do what you would and put together whatever you give to them. So if you're not organized and you're not giving them all of your receipts and all of your documents, you're not taking advantage of all of the deductions that you're entitled to have. Like, for example, legal and professional fees. You may reached out to an advisor early in the year, paid for those fees out of your personal account, but then forgot to bring it over to the business side. So you're missing out on the deduction. And for example, business travel. A lot of times we don't take the full advantage of our business travel. If we plan our travel trips properly, every travel trip can be a business trip. Schedule your meeting, set up the appointments with your clients, give out documents if you're having a book signing, and it's incongruent with the personal travel. If you group it properly and document it, it can become a legitimate business travel trip. And mileages, same thing. You can just take a simple $1 dollar calendar from the Dollar Tree and record those mileages every day, or whenever you have business mileages, because that's the one that we always never take the full advantage of, those business mileages. And the IRS states that you got to have it recorded. So if it's not recorded, the deduction will get disqualified. So if you just make a habit of just recording it every time, or either just add one of the apps, you can add one of the apps on your phone, and it'll automatically track you. So yeah, sometimes it tracks a little bit too much, but it's still a good thing. And then the 179 expense deduction.
Yes.
Say, for example, you had taxable income that year of 30,000, and you need to replace one of your vehicles in your fleet. This would be the time you would do that vehicle replacement, because the 179 deduction, you can take a deduction up to 25,000 each year. So why have a taxable income for 30,000? You need to replace a vehicle that you can get a 25,000 deduction off and reduce that tax liability down. So taxable income down. And again, the same thing with building depreciation. Building depreciation is one of those paper deductions like the 179 expense deduction. The building depreciation, you're getting additional write-offs for the year because you're depreciating that building over a period of time, either 15 to 25 years, depending on what category you're falling in with the depreciation. So you always want to have some type of paper deductions on your return too, because paper reductions are freebies. So if you have the building, the cars that you can depreciate, equipment that you can depreciate, take the advantage of, because they're your expenses. So you may as well take advantage of it. Home office is kind of one of those touchy ones. There's a lot of rules behind the home office, but the most important thing is exclusively use. If you're not exclusively using that office space for your business, it's going to get disqualified. Okay. If there's two or more individuals using the same office, if one person gets disqualified, it disqualifies the second person too. So that one, you really do need to discuss it with your accountant. If you're running more than one business in that office, the accountant really need to know all of the particulars relating to those businesses. And one good example is that say, for example, you have a office location outside of the home. You actually paying rent for another location. And you're spending more time in the in-home office versus that out-home. That would disqualify you for that in-home, because you're only allowed to have about approximately 20% of admin responsibilities that you can do in the in-home in order to get the deductions for both. Because if you're paying rent for outside building, you're going to want that deduction, that 100% deduction. So in order to get that 100% deduction, you only can do 20% of your administrative duties in the in-home office. So you have to, so it's good to talk with the accountant to make sure you're following all of the rules behind those home office deductions. Self-employment tax is pretty straightforward. Every quarter, you need to be adding up all of your taxable income, especially those 1099 contractors. If you if you're a 1099 contractor, you're required to do self-employment taxes, pay self-employment taxes every quarter. So every 3 months, add them up, make an estimated payment between 15 to 20%, depending on whether you know how many expenses you're going to have. If you know what expenses you're going to have, then you can lower the amount that you're going to actually pay for the self-employment taxes. But you are required to pay self-employment taxes.
So that would, let me just, so that would include, like, when we're talking about 1099, and correct me if I'm wrong, we're talking about those that, you might have that side hustle where it's Uber Eats, or you're driving Uber, or you're doing Instacart shopping or Lyft. Those are the type of contracted 1099 jobs that you're referencing. Is that accurate?
Yes, okay. That's very correct. Yes, and those are the ones that get into trouble the quickest, because that little, $2,000-3,000 extra a month that you're getting, when you pay self-employment taxes at the end of the year, is over 14%, because you're paying the employee and employer when you're self-employed. Whereas if you was working with a company, the company would pay 7% and you pay the other 7%. But when you're self-employed, you're paying the full 14% in self-employment taxes. And that's what hurts everyone at the end of the year. They've already used, that side hustle was done for a reason, because they needed the funds. But then they forget at the end of the year Now I have to pay self-employment tax of 14% on $10,000. I don't have this extra couple $1,000 set to the side. So if you pull out that little bit every quarter, then that would alleviate that stress at the end of the year, to paying the full amount at the end of the year.
Such great knowledge. Thank you. So continue with when you start talking about the hiring the family members, oh, that was awesome.
Yeah, family members. Okay, hiring family members. You can hire your child. Now, there's some labor law rules too, that the children aren't supposed to work so many hours and so many days. Again, get with the accountant and make sure you're following it in all of the rules. But as just a general purpose, if that child is shredding documents for you, filing documents, I have one grandson that uploads my files to my iCloud, because he loves working with computers. So I just put him to work. So he does my uploading. One grandson does my paper shredding, my files at the end of the day. So because I use a lot of paper, and I don't like leaving documents laying around. So we make sure we shred them at the end of each day. But the children, the standard deduction is $12,400. So if you paid that child $5,000-6,000 in a year, the standard deduction is $12,400, half of that. So it's they're gonna net out to zero, because the standard deduction. So they're gonna net out to zero. And the funds, you can also set up a Roth IRA account for that child, because now that child has their own earned income. So putting funds in a Roth account for a child at age 12, 13, 4, 5, 6 years, that's a nice investment that child can have by the time they get ready for college.
That is so good. And this is how wealth continues to build from generation to generation. Now, when it comes to
go back to that family, also your landing pages. A lot of the business owners use their children in their landing, in their videos. So if your child is participating in your video, and your advertisement is the same. If it's no different if that child was working for JCPenney's or Target, doing children marketing on a video or advertisement. Because I had one grandson at age 2. My daughter had him in advertisement. He did it for several stores at age 2. So it's the same thing. Why not have your children on your landing page, in your advertisement, your video recordings?
I agree. That is so good. I think about those that maybe they're in the hair industry and they're showing their daughter's hair or their son's hair, or just many different things. You go out to do any type of fair or an event. It could be a book fair, it could be a wellness fair or a farmer's market, and you bring your child with you, pay them for that day. And those are ways that you are able to hire your own family members. That is fantastic. So when we're talking about deductions, we're talking about those activities that can lower our taxable income. But then there are the credits, which is really feels like direct cash. So talk to us about how in the middle of the year, we can manage these tax credits.
With the tax credits, remember the tax credits are dollar for dollar. And right now we're still dealing with the recovery rebate credit, the sick leave employed credit, and the family leave. And the recovery rebate credit, if you did not receive your first and second stimulus check last year on your 2020 tax return, you were still able to get that credit. And I think it's been extended, I know it was extended through 21. So again, if you did not get your first and second stimulus check, it can be calculated on your 1040 when you go forward with your 2021 tax return. And with the sick leave with self-employed individuals, if you were self-employed and you were sick with COVID and weren't able to run your business, the number of days, there's a calculation for you to get a credit if you were out sick for COVID. And the same thing with family members. If you had to take off from your job to take care of a family member, your spouse, because your spouse had COVID, again, those is some calculations that's available credits that you can get for COVID. And the American Opportunity Credit is for the first 4 year of postgraduate studies. That one is awesome. You get that for a total of 4 years. The Lifetime Learning Credit is after your 4 year post. and your continuing education certifications that you do on an annual basis. The child tax credit is pretty straightforward. The child tax and dependent credits. If you have children under the age 17, you're going to get those credits automatically. The residential energy credit. 1 year, which was several years ago, probably about 10 years ago, we did a solar installation throughout our roof. And we got credits for 3 years on the solar installation that we put in our home. So, and then when you're replacing like your water tank, air conditions, depending on the havoc requirement restrictions on it, it'll tell you yes or no whether you fit in those home improvement installation credits. So again, give the information to your accountant. They can go through it and they'll be able to help you with it.
Okay, that is fantastic, because I think many times we just kind of scrunch around trying to look for all of those documents. And I think it is very important that your accountant is not there just there for tax time. They are there to help you with tax strategies, to make sure that you are really leveraging every tool that is at your hands, that is in your hands. So what are some things, I know this is kind of more going in, you know, some of it personal, but it's just great information. And I just thank you so much. What are some things that we should be talking about with our tax advisor? Maybe we just don't know like what kind of conversations we can be having. What are some other things that we can talk about with our advisor?
One of the things I do with most of my clients throughout the year is that, and I try to do it like mid-year about this time, we talk about asset protections. If you have rental investment, rental property, any type of investment that you want to protect and make sure it is there for long term, for transfer wealth to the children, the next generation. So we talk about asset protections to make sure that they have a trust or something in place to make sure those assets are protected, especially real estate. And then estate planning, it pretty much goes hand in hand with the asset protection. And will, I always ask my clients, do they have a will? If they don't have a will, if they have a will, when the last time you updated? You know, sometimes we put the wills together early on when the children first born, 10, 15 years. I tell you a good secret. When I got ready to retire from IRS, I had one son that was not on my beneficiaries. I never thought to update him on the life insurance policy with my job. The 2 kids that was there at the time I got the job was on there. Never thought to go back to add him on there. So he got added on 28 years later. Wow. He got added on to my life insurance policy. Just something simple as that. You just don't think about those little small things like that. And a medical POA. Now with COVID, instant medical fiasco can start. And no one but that person with that medical POA can assist you if you know that you don't have a spouse or someone else that can step in to assist you. And with the general and business power of attorney, same thing. If you're sick, who's going to continue to run your business while you're sick? Why not have a designated individual with the business POA to be able to at least go make your deposits, make sure all of your expenses got paid for that month. So that one is very, very important, the business POA. And the self-directed IRA, that goes back to building your asset wealth. Yes. At the end of the year, you got a taxable profit. What are you going to do with all this? You can shelter a percentage into your IRA account to, again, reduce your taxable income, which then reduces your tax liability, and you're building wealth for retirement. Because when you're self-employed, you're the only person going to fund that retirement account. If you don't fund it, you have no retirement at the end of your career. And the longer you wait, the more catch up you're playing it toward the end. So not like it can never get done, but why play catch up when you can start at the beginning, sheltering the income into the self-directed IRA account. And life insurance annuities is another good one. Once you've maxed out on the 401ks, your Roth, okay, I have excess funds. What do you want to do with those excess funds? A life insurance annuity is awesome because that one is in that non-forever tax column that we talked about. You know, we have those forever tax columns and the non-tax columns. The life insurance annuity and the Roth are the only two that you can withdraw funds in retirement and not have to pay taxes on them. So it's a good to have that balance. You need that balance. The IRA account, Roth account, and the life insurance annuity. And by doing all of that, you can reduce and eliminate some of the tax penalties and things like that toward the end.
Such great information. I know that we are getting ready to kind of wrap up here, but here you have different tax plans. So talk to us about what we need to know as we build towards retirement. Because sometimes when you are a small business owner, you are just focused on how do I get through this day and all the many fires you're trying to put out. But take us a little bit, few years ahead when it is time to sell that business, retirement. What should we know?
What you should know toward when you start planning and getting ready for retirement is what categories you have. Remember, we talked about the forever tax and the never tax. The never tax is our Roth accounts that we build up over the years, our life insurance annuities, and it could be an inheritance. If you get a life insurance inheritance, that's not taxable. So that sits over in the non-taxable side. But then on the forever tax side, if you get a pension from your job, or either you're withdrawing funds out of the 401k and your IRA, again, those are taxable. Now, one good thing about this column is that if you have rental investments does not affect your Social Security. Whereas, because when you say, for example, you retired at age 62, you're not at full Social Security age yet, which is 60, depending on your year you was born. Mine is 66 and 10 months. So any additional income I make at between age 62 and 66 is, and I'm drawing Social Security, I'm limited how much funds I can make. So in order to avoid the income limitation, rental investments is an awesome tool for retirement. If you build up real estate investments in the early years, and that residual income is coming in retirement, it's a gold mine, because it's taxable, but it does not affect your Social Security.
Okay. I wanted to make sure that everyone knows how to get in touch with you. So here is information on office phone number. I love that you are virtual, that you're able to service anyone in the US. Thank goodness for technology. So here's the information for Miss Lillie Anthony. And I just really, really want to thank you for providing all this information for our viewers today. So with that, thank you so much. We really, really appreciate it. And any last words for our business owners?
Just stay organized.
Yeah.
I can't emphasize that anymore. It's to stay organized. Reach out to your accountant, your advisor, and ask questions, because they only can help you if you ask questions. So it's good for you. The more questions you ask, the more you become aware of your own financial situation. And then you're not putting this box that your financial situation is similar to the next person, because every person is different. So you have to ask questions about your financial situation in order for you to expand and grow your financial wealth.
Absolutely. Everyone's situation is unique. So take this information, but more than anything, be inspired to have that conversation and know there are things that you can do now that will have impact on your assets and wealth moving forward. So this has been DPI Presents with the phenomenal Miss Lillie Anthony of ANA Financial Tax Services. Thank you for your time, viewers. All of the information that she talked about will be available. I'll put some links in there so you know how to reach out to her. But thank you and be well, everyone.
Thank you. Bye-bye.